तो जल्दी से जल्दी ऑडियो वीडियो क्वालिटी को कंफर्म कर देना है. So here it is a question that is given to us that will be solving. And 1 USD to INR price is given. 2-month forward is given to be 45/35. And if the person A wants to remit the USD 10,000 after 2 months, what will be the cost to person A that we need to ascertain? Okay, so now the price that you are provided with, if the question is silent about it, I already told you it is a spot rate that is given. So I'm just writing it over here. So USD is equal to 76.10/30. This is the buying rate and this is the selling rate over here. And further, it is now given over here that if person A is to remit the USDs, if the person A is to remit the USDs, now I already told you, now the person A is basically an individual who wants to remit USDs. Now if he wants to remit the USDs, he has to purchase the USDs first of all now. And at what price he will be able to buy the USDs? At the price at which the market is ready to sell. Okay, so he or she will be able to buy the USDs, 10,000 USDs at a price at which the market is ready to sell. So what rate shall be quoted? It will be the selling rate that shall be quoted. So we can simply say USD is equal to 76.30 over here. And further, we are over here provided with the 2-month forward rate. So the 2-month forward rates are given to be 45/35. So these are the buying points and these are the selling points. Now what is the scenario? The currency is available at discount or at premium. I already told you that if selling points are greater than buying points, the currency is available at premium. And if the selling points are lesser than that of the buying points, the currency is said to be available at discount. Now over here in this particular case, the currency is available at a discount. The currency is available at discount. Now when the currency is available at discount, the forward points are to be added up or to be subtracted. The forward points are to be subtracted. The forward points are to be subtracted. Now we will be subtracting what forward points? We will be subtracting the selling forward points. Now you need to understand this particular point. We are considering the selling rate now. So we will be adding or subtracting the selling points only. Okay. So over here 0.35 will be subtracted because the currency is available at discount. So that is the rate that shall be applicable. That is 75.95. That is 75.95. That is the rate that is applicable over there. Now in this particular scenario, now what is the cost? What it will cost to person over here? What will be the answer? It is 75.95 multiplied by 10,000. Multiplied by 10,000. So it is 759500. So that is the answer to this particular question over here. Is that clear? I hope that most of you have understood the concept related to it, that how we do discover the point in the case of the forward rates over there. And further, you must be looking at from the view of the merchant rate or the interbank market rate. Now, if it was not given in the question that A wants to remit the 10,000 USDs, simply you must have considered the buying rate over there. Okay, so that is basically related to it. Now let's move to the another question. It says Forex rate in Mumbai is given to be USD1 at this particular rate. In UK, Euro 1 is given to be 1.05/1.10. An exporter wants to discount the export bill of Euro 10,000. How much amount will be given to the exporter in domestic currency? Now you are aware of the terms like export bill. Now what is export bill? He must have shipped the goods and has drawn the bill on the importer which he has got accepted. And further, now this is export bill that he is basically a rightful owner so as to receive this particular amount, but he has not received it so far. And the question is silent about that if there is any usance period or not. So we'll be considering it to be what? We'll be considering it to be a site bill. So E went to the bank over here, XYZ bank we are considering over here for our reference purposes, and we are just thinking that what price will be quoted by the bank to the customer over here. Now the rate for the forex rate for 1 USD for the INR, it is given to be 68.10/30, and further in UK 1 euro is given to be USD 1.05/1.110. Now what is the scenario over here? What is the scenario? The bill is drawn in Euro 10,000. It's not in USD. You must be keeping that particular thing in mind. So it's in euro over here. So this is the bill which is in euro, that is Euro 10,000. And further it is now to be discounted. It is to be discounted. Now exporter wants to sell this bill to XYZ. In case euro, he wants to sell what? He wants to sell the euros. At what price he will be able to sell the euro? At a price at which the bank is ready to buy. At a price at which the bank is ready to buy, but there is no direct relation, there is no direct currency pair available for euro to INR. So we will be first of all discovering the euro to INR price, then we will be looking into. Okay, so it is 1 USD is equal to 68.10/30. Now what the person E will be doing, person E, it will be thinking from the customer perspective over here. He will be buying the USDs first of all. He will be buying the USDs first of all. Then he will be basically doing it. So what will be the scenario? That he wants to sell the euros. He wants to sell the euros. Now what will be the thinking process? That he will be selling the euros, and he must be selling the euros in USDs. So he will be selling the euros and further will be getting the USDs. And further he will be selling the USDs. And will be getting the INR. So this must be the thinking perspective from the customer point of view. Okay, because no direct rate is available. So customer will be thinking like that he will be selling the euros because he has euro bill with him. So he will be selling the euros and will be getting the USDs. Further, he will be selling the USDs and will be getting the INR. Okay, so that is the scenario. Now what is the euro to USD rate is given? It is given to be 1 euro is equal to 1.05/1.10. It's not visible over here. Let me write it over here. So we can say it is given to be 1 euro is equal to 1.05/1.10/1.10 USD over here. Okay, so he wants to sell the euros over there. He wants to sell the euros. At what rate he will be able to sell the euros? At a price at which the market is ready to buy. So what rate would be applicable? It will be 1.05 euro rate, USD rate would be applicable. So 1 euro is equal to 1.05 USD. Okay, so that is the rate which is applicable in this particular case. And further, once he has received the USDs, he will be selling the USDs. Now he will be able to sell the USDs at what price? At the price at which the market is ready to buy. Again, the buying price over here. So from here we can infer 1 USD equal to 68.10 INR. So that is the case over here. Now over here we are having USD in common, so we will be equating those. So we can rewrite this as 1 divided by 1.05 euro is equal to 1 USD, and further over here 1 USD. Now we will be equating these two. So this will be equal to actually euro divided by 1.05 is equal to 68.10 INR. Simply we will be cross multiplying it, and that will be the answer. So it will be 68.10 multiplied by 1.05, and that comes out to be 71.505. So here comes the answer, 71.505. Let me explain this to you again. So over here we are provided with the different rates, and the export bill was drawn, which is in euro 10,000. Now from the exporter point of view, you must be thinking that he wants to sell the euros and want to get the INR, but no direct currency pair is available. So what he'll be doing, he'll be selling the euros and will be getting the USDs, and then he'll be selling the USDs and then will be getting the INR. So we are provided with the currency pair for euro to INR, euro to ISD, that is 1.05/1.10. Now this is the buying rate and this is the selling rate. Now he wants to sell the USDs. He wants to sell the euros. At what price he will be able to sell the euros? At a price at which the market is ready to buy. He will be able to sell the euros at a price at which the market is ready to buy. So he can sell it for 1.05 USDs over there. That price we considered, and further he wants to sell the USDs now. Over here we have provided the currency pair relationship two-way quotation for USD to INR, that is the buying rate, selling rate is given over there, and further he wants to sell the USDs. At what price he will be able to selling the USDs? At a price at which the market is ready to buy. Again it is 68.10. Now we just simply equated these two quotations over there, and that would be the answer, and there we come with the answer over there. Is that clear? Is that particular part clear over here? Okay. Now let's move further to the next question. So it says, when the exchange rate is fixed by the market demand and supply position, it is called direct rate, floating rate, indirect rate, or fixed rate. When the exchange rate is fixed by the market demand and supply position, it is called what rate? Direct rate is that particular rate in which foreign currency is having a fixed variable, but the home currency is having a variable position, that is a direct rate, and opposite of that is indirect rate, where home currency is fixed and foreign currency is variable, and floating rate is that particular rate which is basically changing its value. It is basically based upon the market demand and supply position. So option B over here is the right answer. Pooja Roy has given the answer correctly at the earliest. Option B is the right answer in this particular case. Option B over here is the right answer. Okay, question number 1, option B is the answer over here. Now, fixed rate is that particular rate in which the regulator fixes the foreign currency prices, and those are not considered as per the market scenario. Okay, so that is a fixed rate. Question number 2, it says if the spot rate is given to be 2, interest rate differential is given to be 4%, forward period is given to be 60 days, calculate the forward points by taking a year is equal to 360 days. So what will be the answer related to the question number 2? We need to calculate the forward points in this particular scenario. We need to calculate the forward points for this particular scenario. So spot rate is given, interest rate differential is given, forward period is given, and it's quite easier that we can do calculate it. So what is the answer? So what is the formula related to it? Let me just remind you again. So it is a spot rate multiplied by the interest rate differential multiplied by the forward period and divided by 100 and number of days in year. That is the formula. Spot rate is given to be 2, interest rate differential is given to be 4, forward period is given to be 60 days, divided by 100, number of days in a year to be considered to be 360. So that is the answer over here. So that is the answer over here that we need to calculate. It is 2 into 4 into 60 divided by 100 divided by 360. That is 0.013333. So Priyanka has answered correctly at the earliest. That is option C over here. And also Raji Ahmed has answered the very first instance. So option C is the right answer. Question number 2. Option C is the right answer. Is that clear? Okay. Let's move to the next question. It says, the delivery of funds take place on August 12, 2013 for the contract dated July 10, 2013. Which of the following rate of exchange will be used? Which of the following rate of exchange will be used? Ready or cash rate, term rate, spot rate, or forward rate? Which one would be the right answer? So which one would be the right answer? It is forward rate. It is a forward rate. So the right answer over here is option D, the forward rate, and Akshay has answered at the earliest. Option D is the right answer. That the forward rate it is. Okay. Let's move to the another question. It says, which of the following rate is used by the bank for purchase of a foreign currency demand draft from its customer? Which of the following rate is used by the bank for purchase of a foreign currency demand draft from its customer? If the bank wants to purchase the foreign currency demand draft, what rate shall be used? What rate shall be used? If you want to buy from the customer, what rate shall be used? What rate shall be quoted? Nothing that way. That the customer visited the bank XYZ and he wants to sell you the demand draft. In a way, he wants you to credit his account against the foreign currency. Or we can say he wants to sell the foreign currency. You want to purchase a foreign currency demand draft from the customer. He wants to sell you the foreign currency. Now, what rate shall be quoted to the customer? It shall be the buying rate which will be quoted. It will be the buying rate which will be quoted to the customer. Are you getting this particular point? And further, there is no differences in between, because at the same time, at the same instance, the amount will be credited to the XYZ account over in case of the demand draft itself. So what shall be the answer? Would it be the buying rate or the TT selling rate or the TT buying rate? What will be the answer? It is option B over here. So Naina has answered correctly at the earliest. That is option B. That is TT buying rate is the right answer. That is TT buying rate is right answer. Let me clarify this to you again. That whensoever the rates are to be considered, you need to look into two factors. First of all, when the settlement is going to be happen and what rate shall be quoted from the bank point of view. Okay, and if you are certain these two, definitely you can answer it correctly. So if the customer just visited your branch and further he wants to sell the demand draft to you, in a way he's selling so as to, he wants to sell the foreign currency to you. He wants to sell the foreign currency to you. Now if he wants to sell the foreign currency, what rate shall be quoted? The buying rate shall be quoted, because the rate shall be quoted at which the bank is ready to buy. So it shall be the buying rate. Okay, and as such there is no differences, so it will be the TT buying rate which will be applicable for this particular transaction. So it will be the TT buying rate. Next question, it says 1 per milli represents which of the following? 1 per milli represents which of the following? One part in every 10, in every 1000, in every 100, or in every 1 lakh. It is one part in every 1000. So again, Priyanka has answered correctly at the earliest. Option C over here is the right answer. That is one part in every 1000. Option C is the right answer. Let's move to the next question. Question number 6. It says the selling rate for foreign currency offered by bank is called. The selling rate for foreign currency offered by bank to call by bank is called what? Kindly please do mention the question number along with it so that I can get it for what question you are answering. So it is an offer rate. So it is an offer rate at which the bank is ready to sell. Bid rate is the rate at which the bank is ready to buy, and the offer rate is the rate at which the bank is ready to sell. Next question, it says a binding contract for purchase or sale of foreign currency at a future date is called. So if there is a binding contract between the two parties that they will be buying or selling, they will be purchasing or selling the foreign currency in a future date, it is said to be what contract? It is said to be a forward contract, and forward contracts are derivatives. These forward contract is also a derivative. It is also a derivative. Now what is a derivative? Derivative is an asset which basically derives its value from the underlying asset. It does not have any value of its own, but it derives the value from the underlying asset. And what type of derivative it is? It is OTC, over the counter traded derivative. It is over the counter traded derivative. Okay, so option B over here is the right answer. Question number 7, option B is the right answer, and Naina has answered correctly at the earliest. Next question says, if a bank is requested to transfer amount from NRE rupee account, non-resident external rupee account, to FCNR bank account, that is foreign currency non-resident bank account of a customer, which of the following rates shall be used? Which of the following rates shall be used? Bills buying rate, TT buying rate, bills selling rate, TT selling rate. What would be the answer? Try to understand the question itself first of all, and kindly please do answer at the earliest. So if a bank is requested to transfer amount from NRE rupee account, first of all you need to understand the denomination. Now the NRE rupee account is basically rupee denominated. It is rupee denominated. Now the customer wants actually what? He wants to buy the USDs. He wants to buy the foreign currency, not USDs particularly. He wants to buy the foreign currency, and further then want it to be credited to the FCNR bank account. Now over here in the NRE account, the amount is basically deposited in INR, and further he wants to buy USDs. Now if you want to buy the USD, at what price he will be able to buy? He will be able to buy the USDs at a price at which the bank is ready to offer, at the bank is ready to sell. That is, the selling rate would be applicable. So the answer will be either be C or D. Either the answer will be C or D, and further the bank will be issuing the USDs at the same time. So there will be no settlement rate difference. So definitely it's not option C. So option D is the right answer. Option D is the right answer. So Akshay has answered correctly at the earliest. That is the TT selling rate would be applicable. Question number 9. Option D is the right answer. Question number 9. Option D is the right answer over here. Next question says, that is basically the part, which of the following department of the dealing room takes care of processing of deals, accounts, reconciliation. So there are three components, or we can say three departments in the dealing room itself. That is the front office, mid office, and back office. Now, which department of the dealing room take care of the processing of deals, accounts, reconciliation? So it's the back office that takes care of that same, and mid office is responsible for the risk management, all the things, and the front office is the main office, which is dealing particularly with the different counterparties. Option C over here is the right answer. Let's move further. Question number 11. It says spot rate is given to be USD 1.320010. 1 month forward, 2 month forward, 3 month forward rates are given, and 1 month forward USD can be purchased at what price? 1 month forward USD can be purchased at what price? Which of the following will be the right answer? Which of the following will be the right answer? Okay, so spot rate is given and simply the purchase rate is to be calculated. So you'll be considering what rate? The merchant rate or the interbank market rate? I just told you that when the question is silent about it, nothing is mentioned. We'll be considering what? We'll be considering the interbank market rate. Now the spot rate is €1 is equal to 1.3200/10. This is the buying rate and this is the selling rate. And in question it is clearly asked, we want to calculate the 1 month purchase rate. 1 month purchase rate means 1 month buying rate. So this particular rate will be considering. So this particular rate will be considering, and for the 1 month forward points are given to be what? These 1 month forward points are given to be 40/35. Now the currency is available at what? Selling points are lesser than that of the buying points. The currency is available at discount. The currency is available at discount, so it is 1.3200. And further we are to subtract the forward points. So it will be 0040 are to be subtracted. 0040 are to be subtracted. You just need to take care of that particular point only. Because we have to consider the buying rate, purchase rate. So these are the forward points related to buying rate only that we need to subtract. Okay, so it is 0.0040 that those are to be subtracted from here. So which one would be the right answer? So it is 1.3160. 1.3160. You need to take care about the merchant rate or the interbank market rate. Now nothing is mentioned over there in the question itself. You will be considering it to be the case of the interbank market rate. For interbank market rate, buying rate is a buying rate, selling rate is a selling rate. So it will be what? It will be the buying rate for the purchase. Okay, so it will be the buying rate which will be considering, that is 1.3200 and not 1.3210. Is that clear? So option C over here is a right answer. Question number 11. It is a option C over here, which is the answer, right answer over here. Now let's move to the question number 12. It says a foreign currency dealer maintains two types of positions which are as under. Now foreign currency dealer needs to maintain the two positions. Which are these two positions? This is related to the funds position and the currency positions. This is related to the funds position and the currency position that a foreign currency dealer has to maintain. So option C over here is the right answer. Option C over here is the right answer. That is fund position and currency position. And Pooja Roy has answered correctly at the earliest. Option C in question number 12 is the right answer. Let's move to the next question. It says, if foreign currency has already been received in Nostro account, payment is to be made in Indian rupee later. Which of the following rate will be used? If the foreign currency cover has already been received in the Nostro account payment and the payment is to be made in Indian rupee later, which of the following rate will be used? Now here is a scenario. Here is a scenario. If the Nostro account is already credited In that particular case, the customer want to sell. The customer want to sell the USDs now, or the foreign currency. Now, at what price the customer will be able to sell? At the price at which the bank is ready to buy. So, as the transaction has already been settled, so it will be the TT rate which will be applicable. And what rate shall be quoted by the bank? It is a buying rate that shall be quoted. So, what rate is applicable? It is a TT buying rate which is applicable. It is a TT buying rate which is applicable over here. So, what will be the answer? So, option B over here is the right answer. Option B over here is the right answer. Kindly please do mention the question numbers along with it so that I could identify. So I'll be keeping as that the Shreyans has answered correctly at the earliest. Option B, that is a TT buying rate, is the right answer. That is a TT buying rate is the right answer in this particular case. Okay, further it says USD is available in Delhi at 1 USD is equal to 76.10 USD. A USD rate in London is 1 USD is equal to 1.10 euro. What will be the euro to rupee rate? What will be the euro to rupee rate? So it's a simple case of the chain rule. Simple case of the chain rule. So kindly please do answer at the earliest and at the earliest over here. So 1 USD is equal to 76.10. So simply do equate the USDs over here. So 1 USD is equal to 76.10 and for the 1 USD is equal to 1.10 euro. Here it is INR, over here it is euro. Simply we'll be equating these two. So we can simply say 76.10 INR equal to 1.10 euro, or euro to INR rate we were to calculate. So it is euro to INR over here is equal to 76.10 divided by 1.10 divided by 1.10. So that will be the answer over here. So that will be the answer over here. So what would be the answer? It is 76.1 divided by 1.1, that is equal to 69.18. So none of the above. That option D over here is the right answer. Option D over here is the right answer. So Nisha Vasti has answered correctly at the earliest. Question number 14, option D is the right answer. So that would be all related to this particular unit related to foreign exchange that we have covered so far. Let me change the file over here so that we could learn the concepts related to the Basel 3.2. So the Basel Accords are there. The Basel Accords are there. Let me just give you a brief history related to what is actually the Basel Accord related with it. Okay. So Basel Committee on Banking Supervision. Actually, it was a group of 10 which basically united over there, and at the end of 1974, the BCBS was formed. The BCBS was formed under the BIS, that is the Bank for International Settlement. Okay, so under the BIS, BCBS was formed. And further, under the BCBS, the guidelines are issued. The guidelines are issued because they know that there are inherent risks which are available in the financial market itself. And those all risks must be ascertained, and further, the capital must be maintained against all those risks. Now, in the banking sector itself, in each and every step over there, the risk is available. Whether it is a risk related to the settlement risk, whether it is related to the currency risk, whether it is a market risk, interest rate risk, credit risk, operational risk. So all these risks are already there. But Basel is importantly concerned about three main risk type, that is a credit risk, market risk, and the operational risk. So the Basel I Accord basically was covering before only two types of the risk, that is related to the credit risk, and the market risk was further added to it in 1996. RBI implemented, you need to memorize these things, RBI implemented Basel I Accords in India in 1992. So these were implemented, these guidelines were implemented, Basel I Accords were implemented in India in 1992, and further the amendment was there so as to include the market risk. Previously they were maintaining the capital only and only for the credit risk, but as per the new amendment to the Basel I Accords, the credit risk market capital is also maintained, and also the capital is maintained for the market risk. And further there were amendments under Basel II, and then there is capital is also being maintained for the operational risk also. आप सिंपली क्वेश्चंस पैक एनरोल करना चाहते हैं तो वेबसाइट यहाँ पर है, एनरोल कर सकते हैं। वीडियोस जो हैं वो हिंदी मिक्स इंग्लिश, इंग्लिश ओनली वीडियोस दोनों अवेलेबल हैं। आई सुजेस्ट कि इंग्लिश क्रैश कोर्स को इस टाइम पर देखें क्योंकि टाइम भी काफी ज्यादा लिमिटेड रह गया है। ओके, अगर आपने ऑलरेडी परचेज कर रखा है तो आपको दोबारा से करने की जरूरत नहीं है, बिकॉज यू मस्ट हैव ऑलरेडी बीन प्रिपेयरिंग फॉर दैट। लेकिन आप अगर अभी से प्रिपरेशन करना स्टार्ट चाहते हैं तो फिर आप इंग्लिश क्रैश कोर्स में ही एनरोल कीजिएगा। ओके, सो थैंक यू सो मच एंड सी यू अगेन टुमारो एट 6 PM in the evening with our class for the bank financial management. Thank you so much and see you again.